Welcome everyone. My name is Greg Brogger. I'm the CEO of Collective Liquidity. This is the second installment of Collective Insights. Very pleased to have Mahadevan with us, founder and CEO of Valor.com. And I'll just say just a thumbnail of explanation about what Collective is, and then we'll hear from Manny and really get started on the main topic. So Collective Liquidity is a platform to provide unicorn shareholders with wealth management tools that they need to effectively manage their wealth. And so we enable both diversification, liquidity, and long-term wealth creation. And so it's really a natural partnership that we find with Valor and Manny, given his expertise and his product set. We find that they're quite complementary. And that is the topic of this webinar: how to combine what Collective does with our exchange fund with what Valor does with charitable remainder trusts. And that is just one of the things that Valor does, but it's a pretty interesting product combination that is quite powerful. But we'll get to that. Maybe Manny, why don't you introduce yourself and Valor?
Thanks, Greg, and excited to be here and appreciate everyone joining. So Valor, so I founded Valor, and the premise was simple. I was going through a startup IPO, and really my goal was, how do I maximize my exit? And this is where it's, today's world, I'm sure everyone here has heard stories about how ex-billionaire is able to avoid taxes legally, and there's a lot of social commentary. My thesis was if these tools and these structures are available, I was just surprised how hard it was for me as an individual to access it. I initially assumed it'd be straightforward and just found it's really hard, expensive, hard to find good help, and very opaque. And so the thesis of Valor is, how do we help people bring transparency to the space to understand what are best practice solutions for different types of taxes, understand what are those trade-offs and benefits, and then also use technologies to make it more accessible and optimized. So how do you use technology to cut down? Historically, there's a lot of professional service fees. How do you use technology to automate? A lot of these are essentially productize one of these illegal documents and approaches to mitigating taxes. And on the administration side, where today historically it's a lot of the costs set up, there's a very slow manual process that really limits accessibility, optimization, because each thing is kind of handled bespokely by your individual versus built to automate. And the whole idea of Valor is, how do we take these tax advantage opportunities and structures and enable individuals to utilize this to more efficiently build their wealth? And to Greg's point, this is a lot of what he was talking about is how Collective brings liquidity and diversification to the set. And, really what we're trying to see is, how do we combine bringing that diversification, that liquidity to a large and growing asset class, and supercharge that with kind of tax efficiency to help build even more wealth for everybody.
Yeah. That's great, Manny. Thank you. And maybe you could talk just a little bit about the number of different solutions that Valor offers: wealth management, tax optimization strategies, et cetera. But maybe we could get into how the charitable remainder trust works, at least at a high level, before we get into how the two exchange fund and CRTs work together.
Perfect. That makes perfect sense. And so just to kind of talk about, so charitable remainder trusts, they're also known as CRTs. A charitable remainder trust is it's very similar to a standard IRA, if folks are familiar with that, or an IRA retirement account. A charitable remainder trust is a tax-exempt trust. And so simply put, what that means is, when you sell assets inside of it, or almost every asset inside of a charitable remainder trust, there's no taxes on the sale. Again, similar to an IRA, but it's not completely tax-exempt. And what I mean by that is, when you take money out of these charitable remainder trusts and it comes to you, that's when you pay the taxes. So it's tax deferred. Again, very similar to an IRA. The practical way that a charitable remainder trust works is, you set up a charitable remainder trust either for a specific number of years, between 2 to 20 years, or for your life or multiple people's lives. You contribute an asset. It's typically an appreciated asset, and we'll kind of explain why, to the trust. When you contribute that asset, you get a charitable deduction. That's typically about 10% of the value of the asset you contribute. So let's say you contributed $1 million worth of shares or equity, you would typically receive at least $100,000 charitable deduction. That charitable deduction would offset your taxes by lowering your income by $100,000. So if you're in California, that could be a $50,000 tax savings. That charitable savings is a small part of the value of a charitable remainder trust. The biggest part of the value is that it enables you to sell the asset and reinvest it tax-free. So let's take that $1 million asset again. Let's say you lived in California and your cost basis was $0. You'd probably pay $350,000 to taxes if you didn't use a charitable remainder trust, leaving you $650,000 to reinvest. But because a charitable remainder trust is tax exempt, if you sold that asset inside of the charitable remainder trust, there aren't any taxes paid while the assets are inside the CRT. So you get to instead reinvest that $1 million. Now, to the part I mentioned earlier is a key thing about a charitable remainder trust is you receive most of that money can come back to you, or you can designate your spouse or family members. So let's say you set up a charitable remainder trust for 20 years. Every year you'll receive roughly 11% of those assets. So if you set up the charitable remainder, so if you have $1 million in there in year one, you'll get $110,000 that first year's distribution. When you get that first year's distribution, you'll pay likely long-term capital gains on that. So again, it's not tax exempt, it's deferred till you take the money out and it comes back to you. Let's say in year two, there's $2 million in the trust. You then get a $220,000 distribution, or 11% of $2 million. Now, this essentially every year, at least every year from the charitable remainder trust, you're getting a distribution. And then you're paying the taxes when you receive those distributions. And the critical part here is because you're able to defer those taxes instead of paying it up front, that in this case, that $350,000 is being reinvested and creating more wealth for you. And that's really the magic of charitable remainder trust, a lot of other tax advantage vehicles like IRAs. Really, the idea is instead of paying taxes, if you can reinvest it, you'll create more wealth. And kind of adding on to that, the longer you get to reinvest that wealth, or the longer the charitable remainder trust lasts, the greater the wealth you'll create. Because the longer assets can grow tax-free, the greater the returns. Now, if you're guessing from the name, there is a charitable component. Beyond getting a charitable deduction, when the trust ends, so if you set up for 20 years, after 20 years ends, or if you set up for your life when you pass away, whatever is left in the charitable remainder trust, i.e. the remainder, would pass on to charity or charities of your choice. So this is where the name charitable remainder trust comes from. And essentially the idea is while the assets are in the charitable remainder trust, they're tax exempt because they could go to charity. When you take distributions, that's when you pay the taxes. And the IRS is trying to even it out of, they're trying to say the value they expect you to give at the end of the charitable remainder trust, that's what you'll receive as a charitable deduction up front. Now, and just to kind of summarize it, because I know that's kind of a lot for folks, is the core benefit of the charitable remainder trust is you can sell the appreciated assets up front. You can sell appreciated assets and avoid paying the taxes up front and instead reinvest that money. Yeah. In addition, that money is going to primarily come back to you. The IRS values it at roughly 90% of the net present values coming back to you. And then you're getting a 10% charitable deduction for the rest. And then when the trust ends, either after a specific number of years or your life, the remainder will pass away to charity or charities of your choice. And really kind of the trade-off here is you're able to sell, reinvest, and grow your assets pre-tax and get a 10%, in most cases, charitable deduction in exchange for typically giving away, the IRS says it's about 10% of the value of the assets you contribute. In most cases, it's lower. It's typically closer to 5% because the IRS is conservative with their growth rates. Yeah. And another kind of, I think, simpler put is there's two really common use cases for charitable remainder trusts. One is selling appreciated assets. The whole premise of this is when you sell appreciated assets, you're taxed on the gains on that. So for instance, let's say you buy something for $200,000 and it's worth $1 million now, you're only taxed on the appreciation. So in this case, the $800,000. And the greater your appreciation, obviously it's a good problem to have, but the greater your taxes. And so charitable remainder trust makes a lot of sense if you can move it into the charitable remainder trust, defer those taxes and reinvest it. This is kind of a common use case. For instance, Phil Knight, the founder of Nike, uses this for a significant portion of his Nike shares to sell these in a tax efficient way. The other common use case, and that's probably most pertinent to most people on this call, the other kind of common use case, I'll just mention it, is it's a common way for parents to pass on their IRAs to their children. Mostly, it effectively allows them to. There's legislation passed in 2017 that forces children to withdraw the IRA more than 10 years and pay ordinary income taxes. Charitable trust allows them to grow that for their life. But most important for folks here is charitable trust makes sense if you're selling appreciated assets and don't need liquidity right away. And I say that liquidity piece is, let's say, and this is probably similar to kind of some exchange fund pieces of, if you say you're selling your startup equity and you need to buy a home and you need all that money, it's hard to use these tax advantage vehicles if you need to spend the money right away. This is, kind of in life, there's always trade-offs. If you need liquidity, you're probably limiting your tax advantage options and some of the, whether it's diversification or other options you have there. So
yeah,
that's kind of.
And just to sort of chime in, I was not familiar with charitable remainder trust before meeting Manny and talking to Valor and seeing where the overlap is. But it really is startling, particularly if you look at the level of wealth or the difference that it creates, particularly over the long term. And that's certainly aligned with what we're trying to accomplish at Collective as well.
I was going to say, and one of the kind of, it's interesting, sad, funny anecdotes on this is, so the U.S. tax code for the last 60 years is roughly grown by about 145,000 words per year. And the U.S., whether or not that's not a win for anyone except for essentially tax accountants and lawyers, right? And maybe the IRS, depending on how you want to see it. But the impact of this is, so the U.S. does have a progressive tax code. There's a lot of consternation as to, is everyone paying their fair share? Like when you look at tax rates, as people earn more, it generally holds true that they pay a higher effective tax rate. Now, it does really break at the very top of the tax bracket. So when you get to that really, the very famous 0.1% or 0.01%, they're essentially, this tax code is so complicated that it's really, and this is part, right? Like, Greg, you're very educated. You know this space, the finance space very well, right? And this was new to you. And I think this is emblematic of whether it's exchange funds, charitable trust. There's a lot of things out there. Most people, you have other jobs, and so it's hard to understand what are those options. This is not what you're going to be spending your time on. But those folks that do have the resources, i.e., let's say billionaires with family offices, they're essentially able to use these, I call them opportunities in the tax code because they're built for specific purposes. They're able to use these to actually lower their tax rate below the bottom 50% of Americans. And this is, to me, that's most emblematic of what people are leaving on the table is right. Most people are just, it's doing what's easy. It's what they're able to do with their time and not taking advantage of too many of these opportunities. The result is, hey, as you make more, you're going to pay a higher tax rate. But what you're leaving on the table is you can drop your, effectively your tax rate to the bottom 50% of Americans because the folks with the greatest wealth are able to do that when they take advantage of every one of those opportunities.
It's interesting. Maybe I can explain a couple of points about how the exchange fund works, because they're similar in the ways that you just said, sort of wealth management tools used by the most well-advised, typically the wealthiest investors and company builders and founders. And I think there's, again, the overlap between Valor and Collective is in, if I can still use the word, democratize access to these wealth management tools. And so our Collective exchange fund works in a similar fashion, which is to say, our exchange funds have been around since the 1950s. Most people don't know about them. They're typically used by public company executives when they have highly appreciated positions, and they want to de-risk by diversifying or reallocating out of those positions. But because of significant appreciation, they're obviously reluctant to pay the taxes, and so on the gains that they've earned. And so the way that they solve for that problem is they will take let's say you own Apple shares, it's appreciated considerably over the last 4 or 5 years. You would exchange those Apple shares into an exchange fund, which would be a diversified pool of other public securities without triggering capital gains tax. And so as you leave your wealth in that exchange fund, just as with the CRT, you're able to drive appreciation, not just on the pre-tax gain, but also or on the tax savings, essentially. And that's what creates over the longer term such a dramatically better outcome. that product had not been viable in the private, or had never been launched in the private market before. And so that's kind of the first thing that we tried to accomplish at Collective, was to make this broadly available to unicorn shareholders. And there's a bunch of different sort of enabling technologies and tools that we do to make that possible. But in a nutshell, you can take $100 worth of your SpaceX shares or Databricks shares or whatever unicorn you happen to hold, and exchange it for an LP interest in the exchange fund of equal value. So if you have $100 worth of, say, SpaceX shares, you could exchange it for a $100 LP interest in this diversified fund of other companies like SpaceX without triggering tax. And so maybe, Manny, I'll turn it back over to you just to kind of talk about then, how do you combine potentially an exchange and an exchange fund LP interest with a CRT, and what advantages does that give you over doing either separately?
Yeah, and I just want to also like hit on a couple of things that that you're calling out. There's like these exchange funds, right? Like this is where it's everyone hopes to have a massive winner in their portfolio that 10x's, 20x's, right? And this is where the downside, the good and bad, the good side is, hey, something's doing well in your portfolio. The downside is, A, it's a lot of risk, right? And then if you do sell it, you pay a big tax. And the whole point you're calling out is historically exchange funds were a way of, hey, I can avoid that tax and diversify so that I'm not forced to sell, right? Assuming I don't need the liquidity, I'm not forced to sell. Now, one of the biggest downsides in the private market, obviously it makes sense in the public markets. Biggest downside of that's all so true. I think particularly even more so true in private markets where startups can grow faster and have, and have astronomical rises and become it's not uncommon to meet people where an individual startup is 99% of someone's net worth, right? And so it is an even almost truer piece. And liquidity is harder to find in private markets, right? In public markets, you can always find a buyer for your shares effectively, but in private markets, it's even harder to find a buyer, and diversification is more important, right? And that's kind of part of the problem. That's really the problem that got us excited as to what you guys are able to bring to solve the benefits of an exchange fund and solving some of the unique challenges of private markets. And the kind of to like add on to this as to how does this CRT plus an exchange fund of 1 + 1 = 3? So there's a couple things, right? Like with the exchange fund, there's one of the core use cases, you get diversification. You're able to say X, to your point, $1 million of, let's say, SpaceX shares. That's great. You may be bullish on SpaceX, but for whether it's family reasons or you want to diversify, hard to do so. Collective liquidity allows you to do so. Now, there's a question of at some point you're going to want liquidity or you want some financial impact. One of the things of if you put the collective liquidity LP shares into the CRT or the SpaceX shares, you get an upfront charitable deduction. So even though you're getting diversification through the exchange fund, you put that $1 million in, you're going to get at least $100,000 charitable deduction, which you're in California and New York, you're a SpaceX employee in LA, that's $50,000 of tax savings right now, in addition to getting diversification. So again, you get the diversification plus you get upfront tax savings, which gives you more free cash flow without doing anything else. And then there's beyond that, there's, you didn't specifically call this out, but one of the unique things that collective liquidity does is, right, it enables you to sell some of your shares in the future if you want to. You may lose some of these tax benefits, but if you need liquidity, you're able to do that. So let's say you do that, whether it's year 2, year 10, let's say after year 7, you pull out and you have 50 company shares and you want to sell, you have some Databricks shares that have taken off and you want to sell that. There's, again, same kind of good and bad thing of these Databricks shares have done really well. So that's great for you. Your portfolio is appreciated, but then you're facing this tax. And so part of the advantage of if you have this inside of a CRT is you can actually sell those Databricks shares or your original SpaceX shares in year 3 and do that in a tax advantage manner where you get to sell it and reinvest it all pre-tax. And kind of the simplest math, right, is you have $1 million of SpaceX shares and you sell it, you could lose $350,000 on that sale if you just sell it in your name. So you'd only have $650,000 to reinvest. And, it's not, crazy math for anybody, but if you invest $1 million into whether it's the S&P, or other assets, that's going to grow faster than if you invest $650,000. And so this combination of the exchange fund plus the CRT, A, gives you that upfront charitable deduction. So you get some tax savings and effectively you're monetizing these illiquid shares right away. You get diversification with the exchange fund. And then in the future, we're going to presume you're going to sell it because people will want liquidity at some point. It's just a question of when, right? Like, well, that's year 2, year 7. When you sell that, you're also able to sell that pre-tax and reinvest it pre-tax. So you're getting kind of at all these different points, you're getting additional growth and tax advantages, and this is where, it's one of the things that I spend all my day doing this, but forgetting the famous quote of like, compounding is the 8th wonder of the world. It's hard to, and we're going to run through numbers, but all these things really add up to make really significant life-changing levels of kind of wealth with your time.
Yeah, well, and I just to maybe say the same thing a slightly different way. The combination of these two products allows you to take SpaceX shares, contribute them or exchange them into the fund, get an LP interest of equal value. So now you've got diversification. Contribute that exchange fund interest into the CRT. Over time, redeem that exchange fund interest for cash within the trust so it doesn't generate tax, and then buy further diversifying assets. So you go from owning one stock to a pool of unicorns to a completely, over time, diversified, sound financial, portfolio. You get to make a long-term financial plan that solves your needs, your financial needs, and your family's needs, able to take liquidity when you need it, but when you don't, allow those assets to grow and be reinvested on a tax-free basis. And I think that's sort of the dream of so many unicorn employees is they have something, they have wealth on paper, they know it's over concentrated, so they know it's quite risky, but there's no way to get from there to how do I provide a sound financial foundation for my family for the next 30 years. And so I think it's this combination of products that maybe does that in probably the best way, certainly that I know how.
Yeah, totally. And 100%. And I think this is where it's like, this is, having been in this spot, and I'm sure a lot of people on this call, right, is it's nice to have some startup equity that's been a winner. But one of the downsides you think about is whether you're looking to buy that home or think about the next steps in life, it can also be scary because like the nature of everyone in startup space knows is stocks can go up and, can go be hot, cold the next second. And, you don't know. And it's the, exchange fund gives you that diversification. So you can, whether it's proverbially or literally sleep better at night, knowing that, hey, it's not just tied to one thing. And you can feel better, but then you're able to this other piece of, and I think of this compounding. The easiest way to think about this is, let's say your assets are growing 10% a year pre-tax. Maybe after taxes, you're only growing 7 or 8%.
Right.
And the reality is like, that you can kind of do this if you take, 1.07% to growing for 40 years versus 1.1% for 40 years, those numbers are going to be astronomically different.
Yeah.
And that's kind of the exchange fund, you're able to diversify, do that tax-free. And in the future, when you do sell, you're able to do that in a tax advantage way. And you're really able to kind of combine those things to diversify, grow pre-tax, and really create significant amounts of wealth. And, do you think, Greg, it makes sense to kind of start to walk through some of them?
Yeah, maybe I think we worked a little bit on a case study. Maybe we could share some of those numbers just so that people can see in concrete numbers how significant the difference is.
Yeah, let me pull that up here. So and just I figured we'd start with, I think most people are familiar with IRA accounts or individual retirement accounts. This is really just a chart of an IRA. This is if you're not using an IRA to save, it's probably a good idea for a lot of folks. And the IRAs were created to essentially for tax deferral to create more wealth. And what is really illustrative is paying taxes in the future is generally going to be worse than paying taxes now when you can reinvest that money. But let's take the scenario we kind of we're working through is someone who has $5 million of equity in a startup. Their cost basis was $250,000. They're a New York City resident, so all the joys of New York, except the high taxes. If they sell today, they would roughly owe, $1.8 million. This individual, their family, they're thinking about, they have kids, spouse, they don't have many liquidity options on the table today. And so this is where collective liquidity comes into play is, hey, they have $5 million, they've done well, they still believe in their company, but they want some diversification so they don't have to worry for this turn to zero, and they can plan their financial life a little bit more stably. So they do a $5 million flop into the fund. So in this case, they've gone from $5 million of one stock to an LP interest that holds a diverse array of other startups. Then after they do that, they contribute their LP interest into the charitable remainder trust. In this case, they're setting up a charitable remainder trust for their life. When they contribute that $5 million, they're getting roughly a $500,000 charitable deduction. In New York, that's roughly worth, at their kind of income range, $250,000 of tax savings. So they get a $250,000 tax savings. They haven't sold anything, and they still own their $5 million of kind of LP interest via the charitable remainder trust. Now, critically, let's say they want to sell this a few years in the future. They sell their LP position in the future. Instead of paying taxes on the sale, they're able to essentially sell this tax-free. So this is where they hold it for 7 years, they get the individual equity, and then they start to sell it off. They're able to, it's growing the diverse array of assets, it's growing. But critically, because they deferred the taxes, but in this case, it's $1.8 million, deferring paying taxes on that $1.8 million and reinvesting that over the course of their life. So they're 45 years old, and this is kind of just based on their expected life. They're able to essentially create $42 million of after-tax wealth for themselves versus $20 million if they didn't use this. And this is assuming that they're taking roughly 5% of the assets from the trust after the first 7 years, every year's distributions. And so kind of just taking this in totality, they're effectively doubling their after-tax wealth over the course of their life with using this combination of exchange funds and CRTs. They're able to diversify on day one. So it's really the cutting out the existential risk of this being worth nothing, which means that they can more stably plan for their future. And this is where it's, in this situation, they're saying, hey, let me pull out 5% per year and essentially cover their cost of living and things like that.
Well, and just to sort of share like a use case that we see at Collective somewhat frequently or very frequently, which is that very few of our clients exchange all of their shares in their unicorn startup, right? So this is just taking that portion of their shares that they want to make kind of the foundation of their wealth, right? They're still very excited about their company's prospects, but this just gives them a chance to say, with half or a third or a quarter, I want to use that to invest over the long term. So they still have exposure to the excitement of and the upside potential of a unicorn company, but as you said, can sleep a little bit easier at night, knowing that if the unexpected happens, they've still taken care of their financial needs over the long term.
Yeah, 100%. And that's, I think, very similar to what we see. Even when people sell their startup shares in a charitable remainder trust, they're typically contributing some percentage of it, because this is where it's, hey, if you believe in this, and this is where it's often of like, if you're spending your time building whatever company you're at, you're still probably believing the upside, or you wouldn't spend your time. But this is where portion, some, like, you have optionality there, and you can also add, right? Like whether it's the exchange fund of, you don't have to make a decision of, this is my only time interacting, right? You could contribute some shares now, contribute more later. You can also do that with the CRT. And so the point is, this is kind of an iterative process, but it's also a diversify, de-risks, and then how do you, in some sense, and this is with the combination of CRT and exchange fund, you can monetize and get some tax savings now. And so these creative ways where you're still holding exposure and some of this ownership, but also diversifying and monetizing. Another kind of, I think, unique case that we really see is, we see a lot of folks who, they've got a lot of equity in one company. You know, they're starting to worry about this. They're still bullish on the company, but they want to, and this is where it's like, whether it's they're spending more money personally, but then they get into this weird spot of, do I have this money or do I not? Right. And it is there's a liquidity piece, but there's also just this volatility of, if you have equity in one company, it's very volatile as to what you get. So it's hard to financially plan up your spending plans and things like that, versus if you own 50 companies, it's a little bit more stable. So there's one piece of, I have a little bit more peace of mind as to what I can consume. And then the other part is, candidly, there's not a lot of, depending on the time of the market, you know, right now I'd say there's less less liquidity in the market, less buyers, or buyers are obviously taking more advantage. And so kind of one of the things that we see is really powerful is collective liquidity is a way for people to effectively, you know, there is a buyer and there's different, variations of this, is whether it's you're holding for diversification and or in the future you're selling some of your shares or your LP interest, but it is a way to monetize this really hard to monetize asset.
Yeah.
Right. And that's, to me, it's also one of the biggest hangups and constraints when I talk to friends or other people, or even people in the startup spaces. It's great when you see the upside and you see these success stories, but like there's too many stories of paper wealth, right? Or you can't utilize this, or it's a long time before you can. And so people do want to enjoy the fruits of their labor.
I think everyone who's been in the venture space through a couple market cycles knows a number of just really sad tales where people were paper millionaires or deca millionaires or whatever it might be, only to find the market change, something unexpected happened, and that wealth all evaporated. So certainly that's an issue. We're starting to get a couple of questions which maybe we can cover. So I just well, let me say one thing first, just about the liquidity side and how liquidity works at Collective. So once you take that LP interest, contribute it into the CRT, at the end of any quarter after the first year, you're able to redeem that LP interest for cash. And so I probably should have said that sort of up front, but the idea being as you want to diversify further out of just a venture-backed, even a diversified portfolio like Collective, you can redeem part or all of your LP interest and then use that to go buy the S&P 500 or bonds or whatever other diversifying assets you might want. And per Manny's point, it's having that predictability, that access to liquidity when you need it, when you either want to take a distribution because you have cash needs or you want to buy diversifying assets is a really significant advantage, because for most private company, even high profile unicorn type companies, it can be very difficult and unpredictable to get liquidity when you need it. And so this is a way to solve both for liquidity and in a tax advantage way. One of the questions we're getting is, what are the risks of a CRT? Manny, what can go horribly wrong with somebody who puts assets into a CRT or can?
So the number one, I'd say one of the biggest constraints of CRTs is liquidity, ironically, and I mean in a different way. So typically, the idea of a CRT is that you don't need to spend that money up front. You're looking to reinvest it. Whether it's you have equity in one company, the real idea is you're selling it and reinvesting it. It's not meant to, let's say you want to buy a home. Let's say you have $2 million of equity. Let's say you have a $500,000 down payment. You may, and again, to this partial piece, you probably want to keep that money set aside and outside of the CRT. The CRT distributes money over the course of the trust. So it's typically distributing 5 to 11% of the trust assets every year. So this is one of those things of, if you need 50% of the money this year to buy a home or something else, it's probably less of a fit in those early years. Now, over time, you can defer distributions, so you can take larger distributions in the future. The CRT can make sense if you need money in the future, but if those early years, it's not giving you really a lot of liquidity.
Got it.
Another key piece is it's tied to the term. You can set these term rate trusts up for a specific number of years, 2 to 20. And an advantage of that is, if let's say you're the beneficiary of the trust, something happens to you, get hit by a bus, the trust is going to run for 20 years in that case, and it'll follow your will as to who the beneficiaries are. But let's say you instead set up a term rate trust for your life. Now, we see most people set these term rate trusts up for longer periods of time. Simple reason is, the longer assets can grow tax-free and pre-tax, the higher the returns. And because of compounding, the returns almost increase exponentially. But if it's tied to your life, what happens if you get hit by the bus, right? Like there's a risk of, let's say that happens in year 4. And so you're worried of, okay, I was planning on providing for my family for 40 years, but I got hit by a bus in year 4. Now, there's a lot of ways to essentially mitigate this. Is you can set up the term rate trust for multiple lives. So let's say you and your spouse's life, or you can set up for the longer of your life, or 20 years. So the floor is 20 years. So if you get hit by a bus in year 4, it's still going to run for at least 20 years. So there's really ways so those are the two biggest risks. Is if you need liquidity up front, it's not going to be a great fit. And then if you set up for your life, how do you structure it so that it's almost like a form of insurance that it's going to run for enough time to create upside for
Actually,
you?
yeah,
Yeah. They capture the
yeah,
upside of tax-free compounding.
that makes sense. And so we're getting another question, which is
I,
different.
I was going to actually flip it on you as like, are there particular risks or scenarios where the exchange fund isn't as favorable for individuals?
So yeah, it's a good question. So part of the way we've designed our exchange fund is to ultimately hold basically the 100 sort of leading best unicorns that we see in the market, so that it's broadly diversified. And so no sector in the portfolio, no industry sector, so SaaS or you know, AI or any other sector can represent more than 30% of the total portfolio, and no one company can represent more than 5% of the total assets under management. So, certainly, we are somewhat like an index to venture generally. We're not looking necessarily to outperform the venture asset class, but we do think we're a very sort of effective representation of average returns. I'll call it that, what we aim for, sort of top quartile, maybe top decile returns over time. So we think just as every asset class goes through different market cycles, we don't expect to always be up and to the right. And certainly we've seen with what's happened in the venture space through 2019, 20, and 21, where you have this enormous run up in value and then something of a crash in those valuations. Any investor in our fund is going to share those returns. Now, we're particularly optimistic about where the market is now because we're really launching our fund after the crash and what we think is in the trough. We don't have a crystal ball, but we would argue that historically this is the right time to invest in venture assets, and we think of ourselves as a great entry point.
Yeah, I mean, the other part I'd probably add on is if someone owns one of these shares that you're taking and they're going through a downtime, their volatility is even higher just owning one
Right.
company, right? Like it's the whole space is broadly seeing kind of valuations reset, right? Exceptions to the rules, in certain spaces like AI, but
and to your point, it's not just volatility that is a risk of owning one stock, it's also lack of liquidity. So that's something that's different than it is in the public security. So public markets go up or down, but when you need to sell, you can sell. In the down market, in the venture world, not only do you know your shares are worth significantly less, but you're still unable to sell them even at those reduced prices. And so by exchanging into the exchange fund, again, at the end of any quarter, you can take cash out of your LP position when you need to. One of the questions that we're getting is also what is the role of the company, the private company, or the issuer of the shares? Do they have to approve the sale in order to make this all work? So I want to let you answer that, Manny.
Yeah. So and I think there's different pieces. So in most cases, the answer is probably yes. And this is where I assume, correct me if I'm wrong, similar to exchange it into the fund, and this is kind of more of a common practice that I say today, this kind of iteration of equity in Silicon Valley is companies are more protective about controlling valuations and who shares are sold to. And so the answer is typically yes, you're going to need approval. There's some advantages of this as to whether it's into the exchange fund that it's like a passive entity. It's not going to be, an interest that's going to be a pain on their cap table. If at all, it's actually consolidating and it's more of a passive owner. And similarly, what we found companies have been more willing to allow their employees to sell it inside of a charitable remainder trust because there's a charitable component. It's going to often align with their values of it's doing good in the world. It's it's doing good for you as well as a charity or cause that you care about. So we tend to see it makes those conversations easier, but you're going to need a company approval.
Yeah, and just to maybe echo that, I think certainly companies or venture-backed private growth companies are going to be sensitive about permitting transactions. They almost all have some form of approval, either in their bylaws or a right of first refusal or some way to control whether the shares actually trade or transfer. But we find that when we speak to issuers and explain that we're not a broker-dealer, we're not a marketplace, rather we are a wealth management solution that makes their equity comp, those options that they gave employees, worth substantially more because we enable these tax advantage strategies and enable diversification. Not in every case, but typically we get the support of the company to what we're doing. And as you said, Manny, all of the shares that get exchanged into the fund are held by the fund. And so we are a long-term passive institutional holder that can provide this sort of controlled liquidity that generates long-term wealth solutions for their employees. It just kind of puts us in a different light than, say, like a retail buyer looking to come in and purchase shares in a one-off small transaction. So I think that the answer to that is yes, but typically we get that approval. Well, maybe I'll take this as our last question. It says, if the fund is constructed completely with private companies, where do the quarterly interests come from? So I'm guessing that's probably a question for me at Collective. So in addition to allowing Unicorn employees to exchange their shares into the fund, we also allow cash investors to buy into the fund with cash. And so if you think about kind of from at the highest level, what we're trying to create at Collective is sort of a risk and liquidity utility that sits in the middle of the venture ecosystem. So everybody who's got too much risk because they're overly concentrated can contribute those shares and get diversification and de-risk. And everyone who has no exposure, say family offices or high net worth individuals, can buy into the fund with cash. And that cash is what we use to fund the redemptions inside the CRT, if that's the strategy our client uses, or just to take cash when they need it. And so that I think is, hopefully as if we continue to grow and make this solution more broadly available, it will be really a great benefit to really all the participants, I would say, argue, on the venture ecosystems, the venture investors, the companies, the employees, and the people, the cash investors that want more exposure to a very difficult to access market. Manny, any last words before we break? Anything else to share?
No, I think those, I mean, nothing new. I'd say it's like the biggest point, right, is to hit on is just like, the kind of, for folks with startup equity, I'd say particularly kind of appreciative assets, right? Like the combination of like why this is powerful is you're able to get liquidity and monetization and diversification between exchanging into the exchange fund, getting a charitable deduction with the CRT. Like the power of this 1 + 1 = 3 is mostly people who have these assets, startup equity, is it's hard to monetize. It's very volatile, and it's non-diversified, and you don't know when you're going to get liquidity. And the combination of the CRT plus exchange fund is you're getting upfront tax savings with the charitable deduction. You're getting upfront diversification. You have ongoing liquidity that you can take over time, and that liquidity is going to be tax advantaged to create more wealth in the long run. Mm-hmm. And so it's really creating particularly if you're thinking about long time horizons and kind of planning for your future, kind of financial future, that's going to create a lot of, it's a really powerful kind of combination for folks.
Right. Okay. Well, that will conclude our webinar. We are going to send an email out to everybody who registered that will include a link to the video. And if anybody asks questions that we didn't get to, we'll be answering them directly. And if you want to reach out to Manny and get expertise, particularly on the CRT, support@valor.com is the email. And for me or anybody,
support@valor.io.
Oh,
we are.
You
can check us out at valor.com. We're still migrating emails over to the .com, but it's support@valor.io.
Got it. And you can just email me at greg@collectiveliquidity.com at any time, and I'll route you to the right person that has the answer for you. But that'll do it for this one. Thanks, Manny, so much for joining and explaining to us how CRTs work. Super excited to be working with you and the team at Valor. So cheers. Thank you. All right.
Thanks, man. And likewise.